Most people lose money in investing for one simple reason: they want excitement instead of discipline. They chase trends, headlines, influences, and shortcuts, but they ignore the fundamentals that actually build wealth. I've watched markets rise and fall, bubbles inflate and burst, and one thing has never changed. Wealth is not built by guessing what's hot. It's built by understanding what lasts. In 2026, the rules of investing haven't disappeared. They've become more important than ever. The noise is louder, the speed is faster, and the mistakes are more expensive. If you don't have rules, the market will teach you lessons the hard way, and tuition is very high. I didn't build a business by gambling. I built it by knowing what I believed in, sticking to principles, and ignoring the circus around me. Investors who survive and win over decades think the same way. They don't panic when markets shake. They don't celebrate too early when prices rise. They understand that investing is not about being right today. It's about still being standing 10, 20, 30 years from now. In 2026, the smartest investors are not the loudest ones. They're the quiet ones who follow rules when everyone else is emotional. The first rule every investor must understand is that investing is ownership, not speculation. When you buy an asset, whether it's a stock, a business, or real estate, you're not buying a ticker symbol. You're buying future cash flow, management decisions, and long-term value creation. Too many people treat investing like a casino. They buy something today hoping someone else will pay more tomorrow. That's not investing. That's hoping. Hope is not a strategy. In 2026, with algorithms, AI trading, and high-frequency speculation dominating short-term movement, long-term ownership thinking is your only real edge. If you wouldn't be comfortable owning a business during a market shutdown, a recession, or a bad year, you shouldn't own its stock. I never invested in things I didn't understand. Complexity is not intelligence. Simplicity wins. Businesses that solve real problems, generate cash, and operate with discipline will always outperform flashy ideas with no fundamentals. If you don't understand how money flows through the business, how costs are controlled, and how customers are retained, walk away. There will always be another opportunity. Capital preservation comes before capital growth. The second rule is that discipline beats brilliance every single time. I've met very smart people who went broke and very ordinary people who became extremely wealthy. The difference wasn't intelligence, it was discipline. Smart people often think they can outsmart the market. Disciplined people know they don't need to. They stick to allocation rules, risk limits, and long-term plans, even when emotions are screaming at them to do something stupid. In 2026, emotional discipline is the rarest and most valuable investing skill. Markets will tempt you. When prices go up fast, you'll feel pressure to chase. When prices fall, fear will convince you to sell at the worst possible moment. Discipline means you invest according to a plan, not a feeling. You don't increase risk because you're excited, and you don't abandon strategy because you're scared. I built Home Depot by executing boring fundamentals repeatedly: cost control, customer service, scale, and patience. Investing works the same way. There's nothing glamorous about winning slowly, but that's how real wealth is built. The third rule is to respect risk before you respect reward. Most people focus on how much they can make. Successful investors focus on how much they can lose. Risk is not volatility. Risk is permanent loss of capital. In 2026, this distinction matters more than ever because volatility will be constant. Political shifts, technological disruption, global conflict, and economic cycles will keep markets swinging. If you panic every time prices move, you're not an investor. You're a victim of noise. Risk management means diversification with intention, not randomness. It means understanding concentration and knowing when it's justified. It means never risking money you can't afford to lose in speculative assets. I never bet the company on one decision. Investors shouldn't either. One bad move shouldn't be able to wipe you out. Survival is the first goal. You can't win if you're out of the game. The fourth rule is patience is not passive, it's strategic. People think patience means doing nothing. That's wrong. Patience means doing the right thing and waiting while others quit. The market rewards those who stay invested in quality assets long enough for compounding to work. Compounding is slow at first, then unstoppable, but it only works if you give it time. In 2026, people want results in days and weeks. Wealth is built in years and decades. I've seen investors abandon great businesses because returns weren't fast enough. I've also seen them jump into terrible investments because returns looked exciting. The market punishes impatience relentlessly. You don't need to catch every opportunity. You just need to avoid the big mistakes and let time do its job. The most powerful force in investing is not timing the market, it's time in the market. The fifth rule is that values matter more than predictions. Nobody knows exactly where the market will be next year. Anyone who tells you they do is selling something. What you can control is how you behave, what standards you follow, and what principles guide your decisions. Investors with strong values don't cut corners. They don't chase hype. They don't lie to themselves about risk. They stay honest about what they know and what they don't. I've always believed capitalism works best when it's rooted in responsibility. The same applies to investing. You should invest in businesses that create value, treat people fairly, and operate sustainably. Over time, companies with strong cultures and ethical leadership outperform those built on shortcuts. In 2026, reputation, governance, and long-term thinking are not soft factors. They are financial ones. Let me be very clear about something most people don't want to hear. Investing will never make you rich quickly unless you're willing to risk losing everything. And if you're willing to risk losing everything, you probably will. The goal is not to get rich fast. The goal is to get rich permanently. That requires humility, consistency, and self-control. It requires saying no far more often than saying yes. Every market cycle produces new tools, new platforms, and new stories about how this time is different. It never is. Technology changes, human behavior doesn't. Greed, fear, overconfidence, and panic will always drive bad decisions. The investor who wins in 2026 is the one who understands themselves better than they try to understand the market. I didn't succeed because I predicted the future. I succeeded because I prepared for uncertainty. I built systems that worked in good times and bad times. Investors should do the same. Build a portfolio that can survive inflation, recession, political instability, and technological disruption. Don't rely on one outcome. Plan for many. One of the hardest lessons investors learn is that doing nothing is often the correct decision. Overtrading destroys returns. Fees, taxes, and bad timing quietly eat wealth. The most successful investors I know make fewer decisions, not more. They wait for clarity. They invest with conviction. They hold through discomfort. If you remember nothing else, remember this. Markets reward responsibility, not recklessness. Investing is not about proving how smart you are. It's about building something that lasts. In 2026, when the world feels uncertain and information feels overwhelming, the investors who win will be the ones who slow down, stick to rules, and think long-term. The 5 golden rules aren't complicated. Ownership over speculation, discipline over brilliance, risk before reward, patience over impatience, values over predictions. Follow them, and you won't just survive the next market cycle. You'll emerge stronger, steadier, and wealthier while others are still chasing shortcuts. If you want excitement, go to a casino. If you want freedom, invest with principles.